How can I get the lowest rate is probably the number one question that I get from customers when they're shopping for their loan. And the most traditional way that people think is the best way to get the lowest rate is to call around with several banks and then compare the terms and the rates that they're offering and then select that bank, lock their rate, and move forward. But I'd like to challenge you to think about a different way to do this, and that is timing your lock. You see, if you call different banks, let's say that you call them all on a Tuesday or even Tuesday and Wednesday, and you collect all of those quotes and then you compare them, you're really only looking at a very small window of where those rates are. Little did you know that a week later or 2 weeks later, the rates could have dropped significantly, or they could have also gone up. So maybe the rate lock was a great idea at that time. Problem is that a lot of people don't know. They just look at the rates, they think the rates are what they are, and then they lock it. And they don't think about what's driving the rates, what makes rates go up and what makes rates go down. That's going to be the topic of this video. So as a loan officer, what I have to do is I have to try to figure out the best time to lock interest rates for my customers. And so it's important that you understand what makes rates go up and down. A lot of people don't realize that mortgage rates are tied directly to the bond market. And so when the bond market rallies and people are buying bonds, mortgage rates go down. When people are selling off their mortgage bonds, then mortgage rates go up. So really the question is, what would make a mortgage rate go up? What would make a mortgage bond go up and what would make a mortgage bond go down? In a nutshell, the simplest explanation I can give you is that when the economy is not doing well, there's high unemployment, company profits are going to suffer, then what happens then is that these investment advisors on Wall Street tend to move more money into the bond market, and they do that as a flight to safety because they're expecting stock prices to drop. And so when that happens, mortgage rates tend to come down. Now, the flip side, if they think the economy is doing really well, unemployment numbers are low, companies are making great profits, everything's just great, they're going to pull money out of the bond market and they're going to move more of that into stock to make better returns. And when they do that, that causes mortgage rates to go up. So it's really important as a loan officer that I keep my thumb on the pulse of what's happening with the U.S. market, right? We're going to look at things like unemployment. We're going to look at CPI, Consumer Price Index. We're going to look at PCE, personal consumption expenditures. We're going to look at manufacturing index. We're going to look at consumer sentiment, JOLTS reports. There's all kinds of different things. We're going to look at ADP, payroll, because that gives us a snapshot into what's happening with the U.S. economy. Is it showing signs of strength or is it showing signs of weakness? If it's showing signs of strength, then odds are that rates may go up. If it's showing signs of weakness, odds are that rates could go down. So imagine that you take all these different quotes on a Tuesday, you pick the lowest one and you lock in, and then 2 weeks later you find out that your best friend who's also buying a house ended up with a rate that was much lower than yours. Same credit profile, same everything. You're going, hey, how did you get a lower rate than me? You're going to be pretty frustrated. It could be that your friend was working with a loan officer that kept their pulse on the market and said, don't lock it yet, just wait. And by doing that, they were able to get a better rate. On the flip side, if rates are getting worse, the loan officer can tell you, you need to lock right away. Do not wait because things are going to get worse. Where another bank may take their time. They might take a day, 2 days, 3 days, and you end up with worse terms. So I don't know about you. I would rather take education, take information, and make a decision rather than just picking one out of several quotes and hoping that that was the best rate that I could get.